Okay, let's look at final topic in F2, project or investment appraisal. In some places you will see it called project appraisal. In some places you will see it is called investment appraisal. Both of them mean the same thing. Now, before starting this video, I recommend watching video about relevant costs. I've already done a video in F5, so I will share link in the description. Watch that as well. If you want to watch it before this or if you want to watch it after this, do watch that as well. Okay, so the topics that we will cover in this chapter is simple interest, compound interest, payback period, TVM, time value of money, discounted payback period, NPV, net present value, annuity, perpetuity, and IRR, internal rate of return. Okay, let's look at simple interest. So simple interest is whenever you hear about the word interest, this is how usually interest is charged. Simple interest is interest charged on the principal amount. Principal amount is the amount that you originally invest. Let's say I invested $20,000, and if there is 5% interest annually, then interest would be 20,000 multiplied by 5% will be 1,000 annual. So I can take that 1,000 annual multiplied by 5, it will become total interest. So total amount will become 25,000 after 5 years. So, or you could read like this, 20,000 multiplied by 5% multiplied by 5 gives you 5,000 plus 20,000 multiplied by 20,000 plus 5,000 becomes 25,000. So simple interest is interest charged on the principal amount. On the other hand, when we have compound interest, it is interest charged on the principal amount plus interest. Usually, when interest is given every year, let's say if I invest 20,000 into a bank and bank gives me 5% interest annually, and that is given in cash. It is not given in cash means it is given to me by bank. Maybe I put it in another account or not, it is my choice, but it is actually given. So in that case, that interest would be simple interest. A compound interest is, let's say the same thing, 20,000 invested at 5%. It is calculated different. So the first year is the same. We have 1,000. In the second year, we take 20,000, we add the interest. And we charge interest on this amount because this 1,000 is also stored in the bank account. So interest will be charged on that as well. So next year, $22.50 interest will be charged on this one. So interest is rolled into the principal amount, and then further interest is charged on that principal amount. There is a formula for this as well, but let's for now do it like this. Okay, this is from the previous one. So our final amount after 5 years becomes 25,525. It is 525 more than the simple interest. So compound interest is interest rolled into the principal amount, and then next year's interest will be charged on that. You can do it in another way as well, this calculation. You could take 20,000 multiplied by 5%, power, how many years is it? 5 years. Sorry, 1 plus 0.05, the interest percentage, and power 5 years. It gives you exact same thing. Or if you forget the formula, you can do it like this. Take 1.05, multiply it 5 times. This 1.05 means next year the amount becomes 1, the principal amount plus the interest. And then next year it becomes of the previous amount. So compound interest will always be more than, it will not be less than principal amount. There are situations where it can be same. For example, for the first year, it would be same whether we are using compound interest or simple interest if interest is added annually. But compound interest will not be lower than simple interest as amount. So let's assume that interest was not added annually. What if interest was added every 6 months? Then what will happen? Simple interest stays the same. There is no difference there. We have 20,000. If it is added every half year, then we would have 2.5% interest. 2.5% interest multiplied by 10 times, because now 5 multiplied by 2. We have same amount. But compound interest will be different. So I will use formula 1.025 power 10 times. So now the amount is more. Previously it was 25,525, and now it is 2,600, about 75 more. So when interest is added more frequently, it will become more. The more frequently interest is added, the higher the amount is going to be. Let's look at the same example. When interest is added every year, we have another example, let's say 12%, same thing. If interest is added every year, or every half year, or every quarter, or every month, what will be the equivalent interest? Let's say we have 20,000. If we add interest annually, so it will be 2,400. And 2,400 divided by 20,000 becomes 12%. This is something called effective annual interest. When interest is not added annually, it is added, let's say, every quarter or every half year or every month. It becomes higher as you add it annually. That is called effective interest. So if it is added annually, effective would be the same thing. But let's say if it is added every half year, 6%, 2 times. Now if I take out the interest from it, and divide this by 20,000, it becomes about 12.30%. You don't have to put amount. You can just imagine an amount. You can take 1 multiplied by 1.06 power to this point will give you interest. Like in the previous one, we had 1 multiplied by 1.12, only 1 point, so we have 12% interest. So you don't have to imagine an amount, you can just do it with 1. So it basically tells you what happens to 1 after 1 year. What if we add interest every quarter? That would mean 4 times. 4 times would be 3%. 12 divided by 4 is 3. 4 times, it becomes 12.5%, even further higher than this. What if it is added every month? Means 1%, 12 times, 12.6%. So the more frequently interest is added, the higher the percentage is going to be. So remember, compound interest will be higher than simple interest. It can be equal, it will not be lower. It will be equal if we are adding interest annually and we are only calculating for 1 year. If it is more than 1 period, then compound interest will be higher. And the more frequently interest is added, the higher the amount is going to be. So we will leave it here. We will do kit questions for further practice. Now let's look at the next topic, which is payback period. Whenever organizations are making investment, one thing they look at in investment is the payback period. Payback period is the time in which you receive your initial amount back. The reason you want to know that is maybe you have taken this money from bank as a loan and you want to know that the project will give you the money back in the loan period. Or maybe you are buying an asset, now you have cash and you don't have it for long, you have it maybe for 1 year or 2 years. So you want to know whether a project will give you money back in that period or not. With payback period, we don't accept or reject a project. Obviously, we look at other things as well. But payback period is something called initial screening device. So whenever we are taking a project, first thing we would look at is whether it gives us the money in the period that we need it or not. And then after that, we look at the NPV and IRR and other steps. So for now, payback period is the time it takes for inflow from the project to equal our outflow. The sooner a project gives you your money back, the better it is. There are many reasons behind it. One thing is risk is reduced. The sooner you receive your money, the lower the risk. And also, if you need it somewhere, you can invest in that place. So we have 3 projects here: Alpha, Beta, and Cheetah. We have 6 years project, and then the cash flows are given. And we are investing $800,000 in these projects, and these figures are in thousands. So let's calculate payback period. The way we calculate payback period is this will be given to you in question, this part, the years and the cash flow. So first thing we do is we find cumulative. So first year is only 250. In second year, it will be all years combined. So it will be 500. So in third year, again, all previous years combined. So when your cumulative cash flows become more than your investment, that means you have received your money back. Now the payback period of this project is more than 3 years, more than 2 years and less than 3 years, because in 3 years it is more, in 2 years it is less than our project. If you want to know exactly, it is 2 years. We know that is more than 2. Now in the total amount that we need is 800, and we receive up to 500 in the second year, cumulative. So how much do we need more? 300. Divide that by the cash flow that you receive in third year. Becomes about 0.75. So if we need 400, so in about 75% of the year, in 3 quarters, we will receive our money back. So 2 years in 3 quarters, 2.75 years, or 2 years. And if you take 0.75 multiply by 9, it becomes 9 months. 2 years, 9 months. And our limit is 2 years. We want our money to be taken back within 2 years. So which project should we be considered? I think I wanted to say here 3 years. So our limit is 3 years. This is in our limit. Now it doesn't mean we will accept this project. We will consider that. We apply other factors, NPV, IRR and stuff. Let's look at this other project. Beta, first year would be that 250. Cumulative. If I drag down, automatically formula will be applied. So this is also between 2 and 3 years. If you want to know exactly, we need 800. We receive up to 600 in the second year, and we need 200 more. That becomes 2.5 years, which is less than Project Alpha. So the faster we receive our money, the better it is. If you want to know exactly, half year in months becomes 6 months. 2 years, 6 months. Let's look at this other one. So you are in cumulative, you are basically combining all previous years. So you can see here it is exact 4 years. Exact 4 years. When you have same cash flows like this, in these projects we don't have same cash flow. Same cash flows is called annuity. When you have same cash flows in a project, then you can calculate payback period easily. You could just take initial outflow and then divide that by the annual inflow that you receive. So that is, it only works when you have same cash flows every year. Now, according to payback period, if we wanted to take any project, we would reject project Alpha. This is Cheetah. We will reject project Cheetah because it gives us money in more than 3 years, and we need in maximum 3 years. For now, I will say we will accept Alpha and Beta, but that is not how it works. So actually, we will consider it. Now, in payback period, we talked about the money that we receive. But remember, there is idea called time value of money, or TVM. Time value of money says when you have money received from project in the future, the value of that money reduces. With time, the value of money reduces. In simple terms, $1 now is worth more than $1 in 1 year. There are many reasons behind it. There is interest, there is inflation, there is return that people expect. But it is out of your scope in F2. You will study those in paper F9 in cost of capital chapter. But with time, the value of money increases. $1 now is worth more than $1 in 1 year. $1 in 1 year is worth more than $1 in 2 years. The far money is in the future, the less its value is going to be. It is like something being in the distance. The more it is in the distance, the smaller it seems. The more money is in the future, the smaller it is going to be. So when we consider payback period here, we included the nominal value of the cash flow. Nominal value means the money value, but we haven't included the real value. And the real value of this is going to be less. So these next techniques that we have, the discounted payback period, the NPV, annuity, perpetuity, IRR, all of these use this concept. Okay, before I explain discounted payback period and NPV, you should assume that when cash flows are invested at start of a project, they happen in time zero, year zero. Anything that is spent now, any money that is received now is called year zero. And the value of $1 now is $1. So there is no change in the value of that. Like in our previous example, when we invested 800, the value of that is 800. And the cash flows are expected to occur at the end of the year. Usually what happens, like this money that we received, 250, it will not happen exactly at the end of the year. Some of it will be received in the beginning month, some of it will be received in the middle, some of it will be received at the end. The money that is received in the beginning months will be higher than the money in the middle, than the money at the end. But we don't go into that much details. We assume the whole money is received at the end of the period. So this 250 is received at the end of the year one. This is received at the end of year two. And when cash flow is said to have occurred at the start of the year, start of a certain year, we assume that it happened at the end of the previous year. For example, if they say that there is a cash flow of 200,000 at start of year 5, we would assume it happened at end of year 1, because year 4, because as year 4 ends, year 5 starts. So whatever is occurred now is assumed to be year 0, and the value of that is going to be exact. There is no decrease. And cash flows are assumed to occur at the end of the year, and any cash flow that they say occurs at the start of a year, we assume that it happened at the end of the previous year. Now let's look at the same example, payback period, but this time we will use time value of money concept. I will do it here. So this is the same question. Now, they said discount payback period of cost of capital is 10%. They call it cost of capital, required rate of return. All of them mean the same thing. So assume for now, don't be confused about it, because you will study this in F9, how this percentage is calculated. But for now, assume this is the decrease in the value of money. Every year, the value of money decreases by 10%. If the value of money decreases by 10%, and this percentage will be given to you, then we have a formula for this. We have 1 divided by 1 plus r. This is the compounding formula. But the only thing is we take 1 divided by that compounding formula, and this is called discounting. Decreasing the value of the future money is called compounding. So what I've done is taken 1 divided by 1.10 power. I can link into the years. Now this will help you a lot in F9 when you're doing investment appraisal. Obviously in F2 you will be answering specific things. You don't have to make this whole format. So 1 divided by 0.10, the only thing that changes is here. So this power increases and the value, this is called discount factor. What this basically means is the value of $1 1 year later would be 90 cents. The value of $1 1 year later would be 82 cents. You don't even have to calculate it. But if you learn how to calculate it, it will help you a lot in F9. This factor is actually going to be given to you in exam in something called discount table. There is something called present value table or discount table. If I look at 10% and we have year 1 up to year 15. So you have up to 20% and 15 years. So questions will be from 1% to 20% and they will be up to 15 years. So if you look at this figure and the figure that I calculated here is the same. So for me it is easier to calculate than copy it from there. So I will calculate it. In exam you can just copy it from the table and this table is going to be given to you. So this means that the value, if value of money decreases by 10%, then value of $1 1 year later is going to be 90 cents. That means if we take 250 multiply by this value, it will give us the value of 250. 250 will become 227. If $1 become 82 cents, 250 will become 206. See, it is same amount. But 250 in year 1 is more than 250 in year 2. Remember, this is end of year 1, not start. Start would be year 0. So I can drag it and it will give me present value. So we calculate present value, then we accumulate. So it is between 3 and 4 years. So according to time value of money concept, if you have same amount now and same amount in the future, your worth is not staying the same. It is actually decreasing in real terms, in value terms. You have same money, but in value terms, it is decreasing. Okay, if we want to know exactly, it is 3 years, we know this much. We need total 800 and we receive about 700 in, up to year 3, and we divide this by present value. It becomes 0.32 years. So 3 years and multiplying this by 12, 3.5, 12 months. If you want to be more specific, 3 years, 3 months, and take that 30 multiplied by 0.8412, it will give us 25 days. You can be more specific, but I don't think they will ask in days. So 3 years, 3 months, 25 days. They usually ask in years and months. Or they will tell you between, you have to select an option where it is like this, between 3-4 years, between 1-4 years, something like that. Let's look at this one. So the discount factor is going to be the same. This is called discount factor. If percentage is different, obviously this figure will be different. Otherwise, it will be the same. So we will do the same thing here. Now let's find cumulative. So it is between 2 and 3 years. Now you can see when we look at the discounted payback period, now this is eliminated because it is more than 3 years. This is still in the range. So if you want to know exactly how many years, we have 2 and 800 is total needed. minus 500 divided by 300, 2.9 years. For 2 years, calculate this into months, 11.3 months. Or if you want to be more specific, 2 years, 11 months, and 9.5 days. There's another one here as well. I will leave it for you to answer. Now remember, when we are calculating discounted payback period, then that technique will not work. Just taking it and dividing by annual cash flow, because even though it is same, every year its value is going to be different. So this is payback period. Now if I take this payback period calculation, up to this point, the calculation that you do for payback period and NPV is the same. Now if I add all this cash flow, now payback period only looks up to the point when the amount is more than the initial investment. It doesn't care what happens after. Now if we add all the amount and we minus our outflow, it becomes NPV, net present value. What is net present value? Net present value is the present value of inflows minus the present value of outflows. Now if this is positive, it means this project increases the value of the worth of the shareholders, and it should be accepted. Because our limit is between 3 and 4 years, we will reject it. Otherwise, this project does not decrease worth of the business. So the value that this project gives us in real terms is more than the money that we are spending on it. If we look at this project, so the NPV of this project is also positive, and it gives us payback period between 2 and 3 years. So both of these will mean that we will accept this project. So NPV, if NPV of the project is negative, it means that it will decrease the worth of the business, worth of the shareholders, so it should be rejected. If it is either positive or if it is equal, means 0, in both cases it will be accepted. But if it is negative, it will be rejected. So net present value is taking all the present value of inflows minus outflows, and you have NPV. Okay, so you have two topics in one question. Now this is the disadvantage of payback period. Payback period doesn't look at the project after the payback period has been received. Let's say this project had 500 at 60 years. Then the NPV of this project would have been 545, and this would be 331. But this project would be rejected, and this project would be accepted because of the payback period. Next is IRR, internal rate of return. Now, internal rate of return is used to find sensitivity of a project. Now the cost of capital, or the return that is required by the investors, is 10%. What if this percentage increases? If this percentage increases, then the value of the project will decrease. Let's make this 20%. If I make this 20%, let's make, because this is already rejected because of payback period, let me make this one 20%. So you will see that it decreases. It is still positive. Let's make it further higher. Let's say it is 30%. So now it becomes negative. So the higher the percentage, the lower the value becomes. And there might be a case that it even goes into negative. So we want to know that break-even percentage. Break-even percentage is where we will have 0 NPV. So break-even percentage means above that percentage, project would be loss-making. Below that percentage, project would be profit-making. Why below that percentage? Because when you decrease the percentage, the value increases. So the lower the percentage, the higher the value of the money. The higher the percentage, the lower the value of the money. So find IRR. So you take any project. So you are finding IRR for that specific project. Let's have a project named Zeta. I have invested 800,000 and I want to know its IRR. At 10%, when I calculate its NPV, so these discount factors will always be the same for a specific percentage. So when I add it together, minusing the investment, it gives me NPV of 76. I want to know what is IRR, the percentage where NPV is going to be 0. So because 10% gives me positive figure, I will find a percentage that gives me negative figure. Because this is very closer to 0, I believe that 15% will give me negative. You have to assume this percentage. It will not be given to you. Just assume any percentage. So the discount factor at 15%. So if you look at the discount tables, it is going to be the same as I calculated, but it is easier for me to calculate it than to copy it from the table. Minusing 800. So this gives me negative. That means IRR is between 10% and 15%. Because this is more closer to 0 than 75, IRR would be more closer to this. So middle of both would be 12.5. So I would assume that IRR to be about 14% or 13%, more closer to this one. But you have to calculate it using the formula. And you have to memorize this formula. Remember, the way to memorize formulas is to practice them. So if you practice with them, you will remember them. But remember, one way to memorizing this formula is to know that the percentage now will be, the answer now will be in between both of these. If it is not in between both of them, then we know that our answer is wrong. So IRR formula is IRR equals A plus B, A divided by A minus B, multiplied by B minus A, divided and whole bracket. Ignore this one. So what I've done is translated it into simple terms. I have A, which is lower percentage, plus A, which is NPV of lower percentage, divided by NPV of lower percentage minus NPV of higher percentage. And then higher percentage multiplied by lower percentage. So in our example here, the lower percentage is 10%, higher percentage is 15%, and PV of lower percentage is 76, and PV of higher percentage is 38. So now let's calculate it. So we have 0.10. I will leave it here. And I will do separate calculation here where we have NPV of lower percentage divided by NPV of lower percentage minus, see this is already minus, so minus into minus equals plus 0.36, and then multiply this by higher percentage minus lower percentage. If you can see 10%, 15% minus 10% will give you 5%. So directly multiply by 5%. So do this part first and then add it with that one. So let me correct the brackets. So we have, we don't need this one. So we have bracket here. Okay, I haven't put the divide sign. So 0.33. Now take this and add with it, because, so do this part first and then add with that. So we have 13.13%. So, and which is what we expected the answer to be. Like this formula as well, just like our correlation coefficient formula, it either gives you right answer or it gives you wrong answer. So we know that it is correct. Now let's prove it. You don't have to prove it, but let's prove it. So this percentage should give us 0 answer because it is rounded off. It will not be exact 0, but it would be near 0. So we would consider that 0. The difference is because of rounding off. Now what does this 13.33% mean? Now this means that this project would not be worthwhile if our cost or, that we are obtaining for this project is at more than this percentage. If we can obtain fund for this project at 8%, then it would be worthwhile. If bank would give us loan at 15%, then it would not be worthwhile. So this is that sensitivity, if you are doing sensitivity of the project. Or you could use it like this as well. If our current cost of capital is 10% and IRR is 13%, that means sensitivity of this project is 3%, which means that if the cost of capital of this project increases by more than 3%, then we make loss. Sensitivity analysis is in F5, which is not in investment appraisal, it is in short-term decision making, but in investment appraisal it is in F9. So it is out of your course. Remember, when we have when we do calculation, because we have to assume a percentage, and one gives us positive, another gives us negative, then answer will be in between. If we take a percentage, one gives us positive, another also gives us positive, then answer should be above both of them. Because neither of them give you negative answer, that means you have to further increase the percentage to give you negative answer. If both percentage calculation that you give is negative, then it means answer will be below both percentages. Because if those percentages give you negative answer, it means you have to decrease your percentage further to make it 0. We will look at that in KIT questions as well. Next we have annuity. Annuity is taken from annual. So when you have same cash flow for certain period, that is called annuity. Now it is same investment appraisal, same NPV calculation, but there is a trick to NPV. Let's say if we look at the project Alpha, it gives us same cash flow every year, 250. Then we can do simple calculation using the present discount factor of 10%, minusing the initial investment, then we have NPV of 288. I believe originally Alpha project has different figure, but for this question, I changed the figure. I made it same every year. Now I can do this calculation like this. It will be okay. If I select an option in multiple choice, it would be correct. But when we have same cash flow every year like this, instead of doing this whole calculation, what we can do is, now if I see this is same 250. Now if, let's say I have a question where I have 2, and then multiply that by 1, multiply by 3, multiply by 4, multiply by 2. It gives me a figure of 20. Now why don't I add this part and take 2, which is same cash flow every year, multiply by this 10. It gives me exact same thing. So when you have same cash flow every year, there is a trick that when you add the discount factors of all years like this, multiplied once by 250, it should give you exact same answer. Now this, you don't even have to add this as well. This is also given to you in exam. We have discount present value table or discount table, and then we have annuity table. Now what happens in annuity table, when you look at annuity table, we have year 1. In discount table, we have year 1 separate, year 2 separate, year 3 separate. But when we look at annuity, when we look at year 1, it is year 1. When we look at year 2, it is year 1 and 2 combined. Year 1, 2, 3 combined. So if I look at year 6 at 10%, we have 4.355. And when I calculated it, it was exact same thing. So if I take it from the table and I put it here, I will have the same calculation. The difference is because of rounding off. Simple as that. So when you have same cash flow every year, instead of doing calculation every year, just go to the annuity table and take the discount factor for the year and multiply by that. Now the problem is created when cash flow doesn't start from year 1. Let's say the same cash flow starts from year 3. So discount factors will be different. So if I do it like this, it would give me correct answer, so no problem there. Minus 899. I can add this as well. 3.599 should give me the same answer. Now the problem is with the annuity table. If I go to annuity table, it ends in year 8. If I take year 8 at 10%, 5.335, it includes year 1 and 2 as well. But we don't have cash flows in year 1 and 2. So if I take this 5.335 and multiply by this, it gives me wrong answer. So what you have to do is take this, the year when ends, minus the second year. If you minus the second year, it is both 1 year and 2 years. You could minus this, or you could minus year 1 and year 2 individually, but that would be more time consuming. Just minus this 1.736 because it doesn't exist. Now it will give you correct answer. You could do it like this, or there's another difficult way of doing it. Now if cash flow starts from year 3 and it ends on year 8, how many years is it? 1, 2, 3, 4, 5, 6. Year 3 now is year 3, but if I was standing in year 2, year 3 would be year 1. And then year 8 would be 6 years later. So what I can do is go to the table, find 6th year, which is 4.33. I take that 4.33, multiply by that. Now what it does is, if I'm standing in year 2 and year 3 becomes year 1 for me, it means this value that is given in year 2. This is value given in year 2. So what I will do next is, because it is all added together, I will take the discount factor of year 2, which is 0.826, and multiply by that. Now it should give us same answer. Now this is a little bit difficult to understand. Whichever works for you. Now there will be another situation as well where cash flows start from year 0. Now, one of the inflow from the project is given now. When value is given now, the discount factor of that is 1, because whatever is given now has same value, so discount factor of that is 1. So when I do separate calculations, there's no problem, it will work. Or I could just add these together and multiply it once. Remember, whenever you are confused about the annuity calculations, you can do this and it will always work. Just add discount factor of all years and it will always work. So here, whichever year the cash flows are, just add discount factor of all of those years, wherever it ends, wherever it starts, and it will always give you the right answer. Now if we do it in annuity table, now it ends in year 5. Year 5 is 3.791. Now the thing about annuity tables is it doesn't have year 0. It starts from year 1. So we know that discount factor of year 0 is always 1. So we'll just add that. 1 plus annuity factor of 3.791. And it will work. Remember, whenever you are confused about it, just take the discount factors of each individual year from the table and it will always work. It will be time consuming, but it will work. Finally, so in an annuity, it could be either a straight annuity or an annuity that starts from a year in the future, or an annuity that starts now, year 0. Next, we have perpetuity. Perpetuity is same cash flows received forever. Perpetuity means forever. Let's say, what is the value of 10,000 received forever? If I receive 10,000 forever, I just take the cash flows, divided by the percentage, it will give me value. So 10,000 received forever at 10% is worth 100,000. You might think it is very little amount because we are receiving 10,000 and we are receiving it every year forever. Let me do a little calculation here. Let's say we receive 10,000 forever. I've done about 100 years. And we have discount factor of 10%. So 1 divided by 1.10 power 2. Sorry, power year. I will drag it You don't have to do this calculation, I'm just giving you an idea. See, 10,000 is worth 9,000 in this first year. 1 year later it becomes, so even though it is 10,000 now, but it decreases in value. In about 100 years, that 10,000 seems like 1 year, so $1. So when I add all of these together, you can see 99,000. So if I go further down, it will become more. So this still is near 100,000. So this is how it makes sense. So 10,000 is 10,000 now, but in the future, it is going to be less. Like if you watch old movies, you might see that when they are stealing money from the bank or somewhere, the amount is very less. But that amount at that period was very huge. So when you have perpetuity question, just take the cash flow, divide by percentage, and it will give you the answer. The problem is when perpetuity doesn't start from year one, just like annuity. It is easier just calculate like you normally do calculations. Now if it starts from year 3, it means this figure is given in year 2. If I was trending in year 2, year 3 would become year 1, and this figure will be given in year 2. So then I will take the discount factor of year 2, which is 0.826, and multiply that. It will give me value. Now the value of this is less. The more money is in the future, the less its value is going to become. Another complication that you might have is if annuities start from year 0. This 100,000 remains the same. Now, if it starts from year 0, normally this calculation starts from year 1, so we just have to add 10,000. So this calculation doesn't include this 10,000 received in year 0. And the value, what is the value of this 10,000? 10,000 because discount factor in year 0 is 10,000. Now let me add this here. You will see it makes sense. So if I receive 10,000 in year 0 and the discount factor is 100%, 100% or 1. Now if I add this, it is 1/10,000. See, it makes sense. Okay, so this is it for investment appraisal. In next video, we will do kit questions. Also look at the relevant costs, because in some of the questions, it is important to know relevant costs.